Welcome to the Deep Dive. We're here to cut through the noise and give you the insights that matter from company earnings calls and market chatter. Today, we're jumping into Elastic, ticker ESTC. They just had their Q1 fiscal year 2026 earnings call. We've got all the details, the management commentary, the numbers, and we're going to unpack what it all means. Let's dive right in with the results because, honestly, Elastic started their fiscal year with quite a bang, an exceptional first quarter. They really beat their own guidance and what analysts were expecting pretty much across the board. We're talking non-GAAP EPS of $0.60. The consensus was $0.42, so that's, what, a 42.9% beat? Massive. Revenue also came in really strong at $415.3 million. That's an $18.1 million beat over consensus. Represents 20% growth year over year. Solid. Or 18% if you adjust for currency. And their subscription revenue, that climbed 20% too to $389 million.
Yes, and the Elastic Cloud number really stands out. $196 million, up 24%. That's huge growth in a key area for them.
Definitely. And CRPO, current remaining performance obligations, grew 18% to $956 million. Healthy pipeline there. Profitability looked good too. Non-GAAP operating margin hit 16%. And adjusted free cash flow, $116 million. That's a really healthy 28% margin.
Right. They also grew their bigger customers nicely, those with over 100 call and K in annual contract value, up 13% year over year to over 1,550, added about 40 net new ones just in Q1.
And net expansion rate, how much existing customers are growing their spend? That was around 112%. So existing customers are spending more.
Exactly. These are undeniably strong numbers, top to bottom. And management, Ash Cole-Karney, the CEO, was very clear. He pointed directly to strong AI demand and just solid sales execution, especially around their search AI platform. He literally said they surpassed the high end of their guidance across all metrics. You hear that, you usually expect the stock to just, take off.
Absolutely. It sounds like a textbook perfect quarter. But the market reaction was a bit weird, wasn't it? Like it popped after hours, sure. But then it just sort of fizzled out into Friday's trading, even closed down a bit. So you've got this disconnect, right? Amazing Q1, super confident talk about AI, but the market's hitting the brakes near term. Let's get into that. What really drove these great results? And maybe more importantly, what caused that market hesitation?
That's the core question, yeah. Because on one side, Elastic's whole strategy around AI seems to be paying off big time. They're positioning their search AI platform as, and they use this phrase, the world's leading vector database, which, is fundamental for making sense of data for AI, getting that relevance and data retrieval. That's the key phrase for the AI era.
Right. Vector databases are crucial for Gen AI.
Exactly. And the momentum there is really striking. They said over 2,200 Elastic Cloud customers are using the platform for Gen AI. And get this, over 330 of those are spending more than $100,000 a year. Even better, they added more million-dollar ACV cloud customers specifically for Gen AI in Q1 than in the previous 2 quarters combined.
Wow. Okay, so that's real acceleration.
It is. And the thing about these AI workloads, they're very compute-intensive. They just eat up CPU and memory, which, under Elastic's consumption pricing model, directly drives more revenue. It's built for this kind of usage. Plus, they're making smart partnerships, like with Dell and NVIDIA, specifically to handle these heavier data workloads.
Okay, so AI is clearly pushing consumption, bringing in bigger deals. That makes sense for the revenue beat. What about the actual product? Any key innovations in Q1 that helped drive this, especially tying back to AI?
Oh yeah, definitely. Product innovation was a big part of the story. One of the major milestones was Elastic Cloud Serverless hitting general availability. And that's across AWS, Azure, and Google Cloud. They beat their Q1 targets for that rollout. Management thinks serverless will become the main way people use Elastic Cloud going forward.
Serverless makes it easier to get started, right? Less management overhead.
Exactly. Lowers the barrier to entry, simplifies things. It probably opens them up to smaller customers, new use cases. It's a big deal for long-term growth.
Okay, what else on the product front?
Well, there's the Elastic AI SOC Engine. They call it EASE. It's a new way to connect Elastic's AI tools into existing security setups like SIEMs or EDRs without needing an agent. And they're pitching it as an on-ramp to get customers eventually to switch fully to Elastic security. It's a clever competitive play.
Ah, like a Trojan horse, but for security analytics.
Kind of, yeah. Provide value first, then pull them over. Then for observability, they launched Logs Essentials. It's a lower price tier within serverless for basic log management. Again, expanding their reach. And critically, for the AI platform itself, they rolled out big upgrades to vector search. Better compression, smarter filtering, all default now. That means faster, more relevant AI search results. Absolutely crucial.
So better performance for the core AI function.
Precisely. And they also added eScale cross-cluster search, just making their search capabilities broader and more powerful overall. It was a packed quarter for product.
It sounds like it. Very focused on AI and making the platform stickier and easier to adopt. You mentioned competitive displacement with ease. How are they actually doing against the competition overall? Are they winning deals?
Remarkably well, it seems, especially in security and observability. They said a third of all their new and expansion security deals in Q1 involved kicking out a competitor.
A third. That's significant.
It really is. Yeah. And it wasn't just small deals. They highlighted a 7-figure expansion with a big academic health system where they specifically replaced the existing SIEM. That's a strong proof point against established players.
And do third parties agree? Any external validation?
Yep. Gartner named them a leader, again in the Observability Magic Quadrant for 2025. That's 2 years running. And Forrester put them as a leader for security analytics platforms in Q1 too. Plus, their security product got a perfect score in a business security test from AV Comparatives.
Okay, so the industry analysts and testers are seeing this strength too.
Right. These things matter to enterprise buyers, especially when they're evaluating platforms for something as critical as AI and security.
What about the public sector? That's been a tough area for some tech companies.
Yeah, they mentioned signs of stabilization there, which is positive news. They signed a strategic agreement with the GSA, the General Services Administration. That's a good step. And maybe more importantly, long-term, Elastic Cloud is now officially in process for FedRAMP High certification.
FedRAMP High. That unlocks the big federal government contracts, doesn't it?
Absolutely critical. It takes time, but being in process is a major milestone. They even mentioned an intelligence agency adopted their search and observability for AI-powered services. That speaks volumes about trust and capability.
Okay, so strong Q1 performance driven by AI. New products are landing well. They're winning competitive deals. Public sector looks better. It really sounds like they were firing on all cylinders. Which brings us back to the market reaction. If everything was so great in Q1, why the hesitation? What did the guidance actually look like?
Right, this is where it gets interesting. For Q2, the next quarter, they guided revenue between $415 million and $417 million. Now, year over year, that's still decent growth, about 14% at the midpoint.
But wait, $415 million was the Q1 actual revenue, so flat sequentially.
Exactly, flat to maybe slightly up sequentially. And that seems to be the sticking point for investors, that sequential flatness. EPS guidance for Q2 was $56 to 58 cents and operating margin around 16%, similar to Q1.
Okay, so Q2 looks flat compared to Q1 strength. What about the full year, though?
See, for the full fiscal year 2026, they actually raised the guidance. Revenue guidance is now $1.679 billion to $1.689 billion. That's up from before, representing about 14% growth year over year. They also bumped up the full-year EPS guidance to $2.29 to $2.35. Operating margin stays around 16%.
So they beat Q1, guided Q2 flat, but raised the full year.
Precisely. And management sounded very positive. They described their tone as bullish confident. They said the macro environment didn't get as bad as they'd feared back in May, which helped them raise the full-year outlook. They feel good about AI demand and their execution.
Yet the stock faded after the initial pop.
Yeah. Classic sell the news, it seems. Despite the beat and raise for the full year, that implied flat sequential growth for Q2 just seemed to make the market cautious. A real mismatch between management's confidence and the immediate market sentiment.
It really highlights that tension, doesn't it? Market wants immediate acceleration, even if the longer picture is improving. So given this backdrop, great Q1 raised full year, but this cautious reaction to Q2, what does it tell us about what investors are really looking for in software right now? What's the takeaway?
I think it shows the market's putting a huge premium on immediate quarter-over-quarter growth, almost an obsession with it. Even a strong full-year raise might not be enough if the very next quarter looks flat. There seems to be very little tolerance for any perceived slowdown, even a temporary one, especially in high-growth areas like AI infrastructure.
So short-term focus trumps long-term story, at least for now.
It seems that way in the immediate trading, yeah. But fundamentally, Elastic's position in AI looks like a multi-year advantage. Their search AI platform, the vector database stuff, integrating with LLMs, that's becoming table stakes for modern tech. It's not a short-term trend.
And they have those other catalysts brewing, right?
Exactly. Things like the FedRAMP High certification that's potentially huge for future government revenue, but it takes time. The adoption of ease pulling customers from competitors, serverless broadening their market, those are still ramping up. They're not fully baked into the numbers yet. And the fact that CRPO is strong shows large customers are still committing long-term.
Plus, that consumption model seems perfect for AI.
It really is. As companies use more AI, which needs more compute, Elastic naturally captures more value. It's a model built for this AI scaling wave. Investors will definitely be watching their Analyst Day on October 9th and other conferences in September, looking for more detail on how these long-term drivers will translate back into consistent sequential growth.
Okay, makes sense. Now let's shift gears slightly. Time for our totally speculative, just for fun segment, not financial advice.
Imagine you're pitching a trade idea, maybe a bit wild, but still plausible based on everything we just talked about with Elastic. What's the pitch? All right, here we go. Investment committee, listen up. The pitch is go long Elastic, ESTC, significant position. And at the same time, you short a legacy SIEM vendor, one that's platform bound, doesn't have a really strong native AI story, and crucially, doesn't have clear proof points of winning against modern platforms like Elastic.
Okay, long Elastic, short old guard SIEM. What's the outrageous part?
The outrageous part is directly betting against a potentially huge entrenched incumbent. You're calling the top on their dominance in a way.
And the plausible rationale.
It's all in the Q1 results and the strategy. Elastic is showing competitive displacement, that 1/3 of security deals number is key. Ease is explicitly built to accelerate this. Their search AI platform is a leading vector database, attracting those million-dollar Gen AI deals. And the market's cautious fixation on flat Q2 sequential guidance, it probably undervalues this multi-year AI shift and Elastic's proven ability to execute, especially given they raised the full-year outlook. So the trade is basically a conviction bet that we're in a generational shift in data infrastructure. Elastic's relevance tech and consumption model are built for the AI era, the legacy players. They have a much harder, steeper climb to integrate AI meaningfully and defend their turf. You're betting on the disruptor over the disrupted.
A bold bet on the future of data. I like it, purely for entertainment, of course. All right, so let's wrap this up. To recap, Elastic delivered a genuinely stellar Q1. Big beats pretty much everywhere, driven by that search AI platform, key product moves like serverless and ease hitting their stride, and some positive signs in the public sector.
Yeah, really strong execution.
Strong.
But the market paused on that Q2 sequential guidance. Even though the full year looks better and management sounds very confident, it sets up this dynamic of navigating short-term market expectations versus a really compelling long-term transformation story centered around AI.
Absolutely. And just a reminder, everything we discussed today is for informational purposes only. It's definitely not investment advice. Please always do your own thorough research. So thinking about Elastic, it leaves you wondering, right, is the market too focused on the next 3 months, potentially missing the bigger picture of companies fundamentally repositioning for the AI wave? Or is that caution about near-term growth warranted? We'd love to hear what you think stood out from Elastic's quarter.